Good evening, ladies and gentlemen. To introduce myself, I am Pallavarajan, one of the founding member of PMS Bazaar, and I welcome you all for another insightful edition of our webinar. Today, we're going to discuss about a topic: how Sameeksha Capital uses fundamental research-driven and rule-based investing to deliver alpha. Among us, we have Mr. Bhavin Shah, who is the founder and fund manager for Sameeksha PMS. Along with Mr. Bhavin Shah, we also have Mr. Eswar Menon, who is a fund advisor for Sameeksha. A special thanks to Eswar joining from US. So before I hand over to them, would like to highlight certain points about Sameeksha and a small introduction about Mr. Bhavin and Mr. Eswar Menon. As an investor, basically, if you check with your wealth managers or an advisors, how do they choose a fund before which comes to you as an investment offering? There are a couple of parameters which they put before filtering the fund. There are thousands of funds when it comes to mutual funds, or when it comes to PMS. There are, even in PMS Bazaar, we cover about 90 PMSs, and in terms of strategies, we have 175 strategies. So someone who needs to narrow down in a single digit, it is a very difficult job. But broadly speaking, globally, there are a standard method to filter a best fund. Just to mention few, risk metrics is one, and the behavior of the fund is one. So typically, when I mean risk matrix, behavior is also included within this. So why I am saying this? If you look at Sameeksha Capital or their Sameeksha PMS, they're about 4.5 years old. If you look since inception, market has behaved, upside, downside. We have seen nosedive and so on. But if you look at Sameeksha PMS, they have been consistently performing well when comparing with their benchmark. So one is performance, but is the performance alone is sufficient to filter the fund? The answer is no. Let's say there are two funds, Fund A and Fund B. Within a same period, if it has delivered the same return, how do you choose, a fund with the same return? But as I mentioned, there are a couple of methods to filter. Now, if you look Sameeksha PMS, every time, being it in a quartile or decile or whatever parameter it is, they've been always in the top. To simply put, you would have seen ratings in mutual fund. If I just need to put the same parameter for Sameeksha PMS, I'm sure that PMS would have been in top rated space. So that is the reason, I was trying to highlight this point. So with that note, let me give an introduction about Bhavin Shah and Eswar, and let me hand over the forum to them. So Mr. Bhavin Shah is the founder and fund manager for Sameeksha PMS. In his career spanning over 2 decades, Bhavin has played leadership role in building from scratch 4 top-ranked institution equity franchise, globally JP Morgan. In Asia, it is Credit Suisse, and in India, it is Equirus, all on sell side, and now Sameeksha on buy side. During his career on the sell side, Bhavin enjoyed an unprecedented streak of decade of #1 ranking by the global institutional investors. Bhavin set up Sameeksha Capital to manage his personal savings in an institutional setup. He holds an MBA summa cum laude from the top-ranked University of Chicago and a master's degree in computer engineering from the University of California. Bhavin jointly holds 2 US patents from microprocessor design. So welcome, Bhavin. And I'll move on to Mr. Eswar Menon. Eswar Menon, who works with Bhavin as an active advisor to the fund, is based in California, manages equity portfolio for institutional investors. He is also a member of the board of a trustee that oversees over 3.5 billion St. Joe's Police and Fire Pension Fund. He has 25 years of track record of outperformance and risk control in managing emerging market equity portfolio, which includes India. His typical holding period is 5 to 7 years. He has MBA degree from the University of Chicago, where he graduated summa cum laude. He also has an MS in electrical and computer engineering from University of California, Santa Barbara, and BTech in electrical engineering from IIT Madras. So I welcome again Mr. Bhavin Shah and Eswar Menon for the show.
Thank you.
And over to you.
Thank you, Pallav, for that nice introduction. And welcome all the participants to this webinar. Uh, yeah, just as a disclaimer, obviously this presentation is for information purpose and should not be considered as investment advice. We will talk about various things, including some stocks, and we may have financial interest in those names. So, please keep that in mind. This is not an advice. This is more for discussion. Yeah, let's. So I want to just start by saying that, investing is not an entertainment. We don't believe in any fancy slogans or buzzwords or punchlines, sahi kharido or tight baitho. I mean, those, we are not into those things. We also don't want to glamorize or trivialize stock picking, and fund management. Uh, for us, it's about rolling up our sleeves and doing a lot of detailed, very mundane work at times, because we're trying to remove those needles in the hay and, eventually find those rare gems. I guess I'm using a punchline, but anyway. So, what I'm trying to say is that shortcuts don't work for us. I've seen a lot of work, some of these formula-based scorecards. Those are interesting things to look at, but we also find that they generate a lot of false negatives. So there is no, simple formula for us. And, we do a lot of not interesting things like show up at a factory or 1,500 kilometers away unannounced just to see what's happening when we hear about a factory situation of a shutdown, for example. We try to document almost everything we do. It's actually very boring. And, we use technology to ensure that we adhere to our process, and we are very process oriented. So it's even more boring stuff. So we do a lot of boring work. However, we are never bored because we keep learning and finding out new things. So maybe not slogans, but we do have some guiding principles. Integrity, it's the most important thing for us. And, I read this definition somewhere. Integrity is doing the right thing when no one is watching. So, there are a lot of things that we can do in a PMS, when calculating fees, creating side pockets for investments, some of the trade allocation decisions, but, that's where, we believe that integrity matters the most because nobody is watching us. And, more than 15% of the AUM is coming from the founders, and they have no side pockets in equities. We understand that investing is not rocket science. However, we must embrace technology or face obsolescence in this world of fast-moving information. The ideas, investment ideas, don't remain undiscovered for very long. And so, if we don't embrace technology, we could become obsolete. And we actually started 5 years back as a 100% cloud-based company, and since then we have adopted many technology-based initiatives to keep our work, and I'll talk about that more in detail. We also accept that market is almost always right, especially in the long run. And even in the short run, market is more right than wrong. So we don't try to think that, if we find some, one of my professors, Professor Pallavarajan, who I took corporate finance course with, used to tell that if you see a pot of gold lying on the street, the first question you ask is, why hasn't anybody else picked it up? So, we try not to think that we are smarter than the market, although, market does give opportunity at times. We also like to claim ourselves as a value-focused investor, but, it is very easy to abuse the valuation tools. We try to treat them with respect. We don't get into the multiple expansion game, or, or don't blindly even assume that if something is trading at a particular P multiple, 2 years, 3 years out, it will continue to trade at the same P multiple, blah, 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 blah. I mean, that's not, the way we look at things. So what, and we often find that there are things that we invest with a long-term view, and, what works in the long run sometimes doesn't work in the short run. We do find situations where some investors are not comfortable with the short-term performance, but we do not try to, or, when these days all the data is published on a monthly basis, there is a pressure to deliver on a monthly basis. We try not to worry about that too much. We try to keep focused on long run for the long term, and this is where my colleague Eswar, comes, with that mindset where, as Pallav said, he has a holding period of 5 to 7 years, and that helps a lot in kind of balancing things out for us. I like to point out some of the key differences in the way we do things versus others. First is the flexibility to increase cash position. We have taken very active cash calls in market extremities, and I'll give one example of that as we go further. We have a very clear buy-sell framework that affects our cash level in the following sense, that if we don't have any idea that meets our criteria for buy below, we don't buy. And if the stock trades significantly above our target price and we don't see a reason to revise that, we also tend to exit. That automatically creates sell level, it automatically increases the cash level. And also it may happen that during the time when market is kind of high, we may have more sell ideas, and as a result, automatically the cash level goes up in the portfolio. So it really works well for us. Customization is another important differentiation. We do not follow model portfolio approach. We treat every single client portfolio as if that was our only portfolio. In other words, if new money comes in, we don't simply copy what we already have in other accounts. We only buy what still makes sense to buy. And for that, we have actually, and because as the number of clients grow, it becomes difficult to manage this. And the third-party software available to manage this is not good enough. We have written our own software, and this is what I talked about, focusing on technology to basically manage multiple portfolios this way. Obviously, you don't get this benefit from investing in a mutual fund, and also the cash modulation is not possible in a mutual fund, and also not likely to be seen in many of the large PMSs. Finally, the focus on genuine value. This is extremely important to us. We have set hurdle rates for buying any stock depending on the risk, and the risk includes liquidity and this as well. If the stock does not meet our required rate of return, we don't invest. But how do we derive this required rate of return or expected rate of return is also very important. It is based on a very evolved financial model based on free cash flow or excess ROE if it's a bank or financial company. And the assumptions that go into doing that is where the real the real details come in. And as I said earlier, we do not stay invested if a stock crosses our price objective. Just to highlight, sort of beat about our performance and what we believe it is important to deliver consistent performance over time, not on a snapshot basis. So we have tried to capture all the quarters over last year or so since basically for a 3-year performance. And what you would observe is that we have been consistently among the top performing PMSs. At times when we were not in the top quartile, our performance was still, and those are the periods when market returns themselves were quite good. So we are still above the average, but not materially above the average, perhaps because of our value discipline. But still, we have stayed, pretty much in the top, quartile on an average, on a 3-year basis. And if you compare us to any of the mutual fund categories, we have basically beaten all the categories, and the outperformance is very significant in recent periods. We also like to sort of show you the performance details in 2-3 different ways. So the first table on the top is our performance over periods ranging from 1 month to since inception, which is about 4.5 years now. And these blue lines are basically our performance. So what you would, and then the next 3 lines, the red, green, and purple, is our alpha over small cap, mid cap, and CNX 500. So the broad index. And we are a all caps portfolio. In other words, we are market cap agnostic. Although the large caps inevitably end up being 40 to 50% of our portfolio more often than not. So what you would observe is that while with a big rally in small cap, we have underperformed small cap over the last 1 month and 3 months. However, otherwise for any other period, whether it's small cap, mid cap, or a CNX 500, we have delivered pretty meaningful alpha. Another, I earlier talked about customization. So the bottom left table or chart rather, what I think we are trying to show here is that irrespective of when clients joined us, they have seen very strong alpha in their portfolio. Again, the blue line being the performance of a client who joined 4.5 years ago versus 4 years ago versus 3 versus 2, like that. And the other lines are the alpha over the benchmarks. And this is important because it should not be that the clients coming in at different times. If they come at the wrong time, they suffer because they just entered at the very wrong time. So we by sort of doing this custom approach, we try to manage that pretty well. And finally, on a financial year basis, this is our 5th financial year. So clearly, there was March. One of the green line is actually the cash level in the portfolio. So we have in the early time maintained pretty high cash levels, and despite that, our performance was quite respectable. So look, just continuing the one last and important sort of information about our performance. This busy chart on the top basically compares our NAV, our portfolio value versus all the key benchmarks, and that thick blue line is that, and obviously it has decoupled significantly versus the indices since middle of 2019. And that alpha has increased especially recently, and the light blue line is our cash level, and I think here there is something to learn. We took a right decision to reduce the cash level during demonetization because stocks became available at a very good value, and that was a good. However, as the market continued to rally, I think we kind of were confused about what we're doing, and ultimately reducing the cash level. By the way, the cash level is on an inverse scale, so that's just to keep that in mind. So if the line is high, then the cash level is low. So we ended up having fairly high exposure to small and mid caps prior to that big correction in 2018, and that did hurt us a bit in that period. However, during the COVID, and we have kind of shown that within sort of a more detailed manner in the bottom left chart. However, during the COVID is when we really became very alert in terms of what action we should take. We did increase our cash position significantly to as much as 35%. And thanks to my colleague Eswar, who warned me that the way these markets are, let's be very nimble about this, and let's be ready to redeploy based on any indications or any kind of government policy actions. And obviously, as we all know, there were plenty at that time. So we also reinvested pretty quickly, and that I think has helped us manage through this time frame. I think in terms of what kind of companies we invest, you would hear a lot of this from many PMSs and mutual funds. Obviously, we're looking for companies that grow. We're trying to run a concentrated portfolio of no more than 30 companies. We're looking for companies with some competitive advantage, basically run by good management, etc. However, there are a couple of things where we I think pay more attention. One is that corporate governance. We don't really do any shortcuts here. We have developed an elaborate checklist, and this is kind of evolved over time. We have kept finding new things and added to our list of things we check for. And if the company has done something which is not consistent with good shareholder practices, we try to stay away. And the other important thing is how we understand value. And this is where also we believe that we are unique. We have very very detailed process to understand value, and only if stock meets our criteria, then we invest. Our target zone is both young companies, small and mid-sized companies, as well as sometimes large companies if we find that they are not noticed by the market. So, the lot of large funds, they focus on large market cap companies. We invest across market cap spectrum, and that perhaps improves our probability of finding winners. We end up having several advantages. Even if it's a large company, but if it's not noticed by the market, for example, not well researched, lack of sell side research, we actually get excited because that means there is probably an opportunity to unlock value there. Often some of these companies obviously have a lower multiple to start with, so there is a better risk reward. Younger companies, less covered companies, sometimes the management access is also easier, or if management is not accessible, we find ways to do things that others probably don't focus on. And this is how we have ended up investing in some of the companies, both small and large. I think Muthoot is a good example. For example, we've been owning it for almost 4 years now, and when we invested, nobody was paying attention. And I think there was not a single mutual fund invested in that stock. And I think today we know what the story is. I think in Indigo, Interglobe Aviation is a similar example. Polycab IPO came and there was a lot of skepticism in the market. We did our work and we found something interesting in the name, and that's how we invested. Let me just now get into our research and investment process. We, obviously, we have, both of us come with an engineering mindset, and I think that is reflected in the fact that we do things on a process basis. It is aided by both proprietary tools as well as third-party tools, as a lot of automation that we have tried to do, and I think we will need to do a lot more in future if you want to stay relevant. There are key tools that we have at our disposal, a very long checklist for every idea. We have an online database of financial models that is on Google Apps, embedded with a dynamic free cash flow model that lets us understand the value in any company based on various permutations, and really answer the question of what market is telling us about the future prospects of this company. It's sort of working backwards, taking market input into our equation rather than we figuring out, we are saying this is the value. We have one of the advantages of our technology is that we can go back to what we were thinking about a particular company a year ago, 2 years ago, 3 years ago, any time in the past when or from the starting point of doing the work in the company, and actually see what we thought at that time versus what is happening today. We have deployed a productivity tool so that all these little steps, and I'll show you some more, are mapped into this software. Now, what all of this does is that, one, it helps us identify investment opportunities for sure, but also helps us improve our productivity, achieve consistency. It is easier to bring any new member to the team and bring them up to speed and make sure that they are sort of working in the same direction as we are, and kind of institutionalize our the knowledge. As time goes, our database of knowledge of companies in terms of past history, what we have, our conversations with the management, and our financial model, that database continues to grow, and that really becomes very, very useful when investing. I think this is kind of our process in a nutshell. Basically, the ideas come from many different ways. There's no one place from which we generate new ideas. We kind of keep a list of what new ideas to work on, and then we run it through a number of different filters to arrive at investment decisions. And I think that the research process is such that sometimes we are looking at company A, but actually the interesting opportunity might be in company B, and that also plays a role in our work. Just some examples of some of the investments we have made, and the interesting thing is that these ideas have come to us from a variety of different sources. We keep running different screeners, which kind of give us initial list of names to work with. And a number of ideas have come through that way, whether it's Canfin Homes or Muthoot Finance. but also sometimes attending annual general meetings have become a source of idea. Sometimes, media gives us opportunity. When there was this whistleblower complaint, Infosys stock tanked, and we saw that as a clear opportunity because there was really nothing material in that, and that's how we also grabbed that. And sometimes IPO meets also become source of ideas, like Polycap was. So a number of different sources from which we find ideas. I mean, I think I can't go into the whole all details of our checklist, but there are number of different things we look at when we are trying to look kind of basically filter out the ideas, both qualitative factors as well as quantitative factors. Analyzing past history, obviously. Looking for we try not corporate structure. We try not to invest in companies with complicated corporate structure. We try to, as I said, pay a huge attention to how the shareholder interest management is aligned to, and that's how we keep filtering down to the names that we invest. The investment process. This is really how it is mapped. It kind of looks like some kind of a flow chart of a software, but that's how it is. And there is a two-step process really. There's initial evaluation, which involves interaction with sell side. If there is a research on the company, management interaction, and then doing some initial screening to decide whether it's worth looking at further. And investment committee is all of everybody looking at investments. The entire research team participates, and that is a very democratic process. So it is not just that a fund manager looks at the idea and decides whether to invest or not. The feedback from every person is very valuable in this process. And if it looks like something worth doing, we go into the second level of detail. And all these steps are mapped in our productivity tool, so that because there are so many things to do when investing in a company, it's easy to forget one or two things. By mapping it to a software tool, we make sure that we have covered all of the bases. And document, the archival, making sure that we document what we do is very important. One thing is to find ideas, but another thing is to have some sort of portfolio discipline. And let me talk about that a bit. We obviously talked about the stock selection process. They kind of get rid of any personal bias. We also like to focus on companies which are high quality, as everybody likes to say. But that's not enough for us. There has to be value as well. Which determines our buy, sell, and hold decisions. Active sale framework, as I mentioned at the beginning. If a stock is above our target price, we reevaluate whether it's worth. There is some new inputs, some new potential for company to grow. Then we would invest. We stay invested. Otherwise, we will obviously try to exit. And I think we continue to believe that we have a very unique financial model to understand the value in the company. Risk management is quite important, and let me just point out a couple of important things. Obviously, whether it's a sector exposure or individual position concentration, and we can take very large bets, as much as 15% when invested, or 30% on market value, but that only happens if it's a liquid stock. The experience of the liquidity is a very funny thing. It's a stock can be very liquid, especially small and mid cap can be liquid when market is going high, and then the liquidity disappears the day the market starts to fall. So we try and not take this kind of large bets on small and mid cap names. We actually limit ourselves to a much lower level of position. Now that may mean that even if we like a story a lot, we may not be able to take a very large position in small and mid cap, but we are okay with that. And we have kind of hard coded some rules into our the trading criteria, so that the portfolio does not have very high exposure to illiquid stocks. This is important because in a PMS, investors have the right to ask for redemption at any time, and we have to honor that, and we don't want that to affect our the investments by the portfolio of other investors who remain invested. I just want to kind of now talk a bit about how our investment processes worked over time. So I think more than over last 4.5 years, we have rejected more than 200 companies through our process. And a lot of them rejected after initial evaluation, but a lot more also after full evaluation. And there have been some remarkable names in that category. Companies that looked really great, they were delivering numbers consistently, but we found one thing or the other that made us not invest in those companies. And I think we believe that our process focus, I think, helps us, and our rules kind of help us, prevent from investing in those companies. And I've given some examples. I think there are many more examples that of such nature, but I think clearly our rejection kind of formula seems to work, because if you look at these charts, the companies which we rejected have underperformed significantly. So these companies we have rejected for a number of different reasons, whether on a quantitative factors or qualitative factors, and these factors are often not just business fundamentals, but a lot of corporate governance kind of issues, promoter intent, aggressive accounting, capital allocation, and many times valuation. There's some of the companies that we invested are doing well. I mean, I think you sort of saw some of the names. I think we don't mind holding companies for a long period if there is consistent delivery and still upside in these names. Talking about buy and sell decision, that is what is reflected in this slide. We have the companies that we exit. There's a large number of companies we sold, and the post-exit returns in these companies have not been great, suggesting that our buy-sell framework did tell us, basically give us the right indication for exiting these names. Obviously COVID created a lot of opportunity, and we did make a number of new investments during this period across the different sectors, and clearly a lot of these names came up through the screener. The free cash flow yield for some of these names were very high, and they looked promising from other aspects, and so we have invested in these companies and are still invested. And some names we invested before, like Interglobe Aviation, and to make money, we also chose to reinvest. We also made our we also had our cases of companies where we exited too early. I think this buy-sell framework sometimes ends up pushing us to take decisions on companies which, if we had stuck around, we would have generated much higher returns. And one great example is Nestle. We sold primarily on valuation, and since then the stock has doubled. So we also have our share of mistakes. Some companies we don't regret, exiting, because I know the framework that the framework does, have its, basically, if we have to work with something, we cannot keep changing the method that we apply to investing. One thing though we do learn is that if the is to reevaluate any investment before selling. In other words, is there something more that we are missing? And before taking an exit, let's reevaluate. And we have had companies that were purely mistakes. The companies that we should not have invested. And so, any process is not perfect, and this is an example of that. And I think, we did manage to exit some of these names not too late, but nevertheless, there are some lessons to be learned. And, this is again goes back to kind of having an iterative process. These learnings, become part of our process and, and our checklist, and hopefully leads to fewer mistakes in future. So I think I'd like to stop here and address any questions.
Thanks for your insightful presentation. Uh, Before I open a question in forum, during the registration, we've been asking our users to send us the question to give a priority. So we have collated few questions, and we'll start with that. So then we'll move on to the forum based on how time permits. So, so on a curious note, no, first question, let it come from my side. You have been setting up this Sameeksha to manage your own savings. What made you, or what is your motivation, in managing investors' money?
So, I think the what I felt was it was just my money. I'll get very lazy, and I think that is perhaps not consistent with my nature. I felt that if there is money to be managed for others also, it creates certain critical mass that can be that can be there to invest in resources, invest in capabilities, and as a basically as a result, I do believe that it is not no longer easy to find opportunities in this market. One has to do detailed work, and detailed work requires investment in resources. So that was also a factor. And other thing is that and I have frankly learned this by doing. I perhaps, if you asked me this question 5 years ago, I probably wouldn't know. But managing investor money is a very different level of responsibility. Being an analyst on a side has its own challenges, but being a fund manager, I think the idea that somebody has trusted you with their money, I think it definitely makes one stay on the toes. And I think that I think is a big motivating factor, because I think it keeps me focused on the work every day, and and I totally enjoy it.
Interesting. So, is there any difference between your portfolio and client portfolio in terms of approach or stocks and so on?
There is no difference. We when I give when I when we generate trade instructions, I don't even know how many shares are going to be bought in my portfolio, or how many shares are going to be sold in my portfolio. It is all formula driven, so there is absolutely no difference. The
Fine.
only difference, as I said, the only difference is that if a particular client account has higher percentage cash because it's a new account, we may buy a certain stock in a larger quantity, but that again is formula driven. So that otherwise there is no difference.
Fine, Bhavin. See, I'm picking some three basic questions from the forum. Looks very simple. Let me address. So somebody was asking that, do you deal with NRI investors? Yes, Sameeksha
Yes,
deals with NRI investors. You can
yes,
contact us. We'll help you
yes.
out for that. And Mr. Kannappan was asking about, is there any minimum investment and maximum investment? Yes, as per SEBI regulation for PMS, the minimum investment is 50 lakhs. In terms of maximum, I think Sameeksha is capable to manage even 10,000 crore. And somebody, Mr. Viresh Shah, was asking about what is your stock picking strategy. I think Sameeksha has already addressed during their presentation. Maybe you can, this video would be available in YouTube in a day or two. You can just go and view the video again to understand that. So let me come back with the next question, Mr. Bhavin. In recent time, there are noises around investors investing in global equities, specifically looking at US market rally. So what is your general advice for those investors?
So we have Eswar Menon. I mean, no better person than to answer that question. Eswar, could you address that, please?
Yeah, I think, the US is the largest market globally, and often it sets a trend. And what you've seen in recent months since the COVID crisis started is the market has been flooded with liquidity. So interest rates, have been basically cut to zero. And besides that, you see the central bank balance sheets have expanded, and the fiscal stimulus is very high. So I think what is helping the market the most is that there's a flood of liquidity. Now, are the markets supported by fundamentals? That's a tougher question to answer. I think certain sectors, clearly are doing better during the COVID. Companies which benefit because people are working from home, things like that, they're doing well. On the other hand, I think there are sectors which are affected, like hospitality sectors, restaurants, transportation. All of those are not doing so well. Now the question is, what happens as things continue if you don't resolve this problem? I think there definitely is stress in credit markets, and that's the issue which we'll have to figure out, because I think credit markets often drive equity markets. So at this point, my view is it probably makes sense to be more cautious. I think the valuations are not as supportive, and liquidity is driving everything. And I think the credit markets could face stress, in the next, 6 to 9 months. So I'd be a little more cautious.
Ishwar, from a longer term perspective, I think if you could also address, like, for an Indian investor, I think that's probably part of the question. How should they think about, US investing outside India versus India?
Yeah, I mean, I think the US market is a phenomenal market, right? I mean, like I said, it's the largest market. It sets a trend, and it is probably the market where you see the most innovation. I'm, like as Bhavin said, I'm on the board of the San Jose Police and Fire Retirement Fund. We manage $3.5 billion. And we look at opportunities across various asset classes. So it's not just equity, so it's bonds. And also we do private equity, venture capital, real estate, all of those things. I think the opportunities in the US are tremendous. And so, when I talk about short-term concerns in terms of credit markets and effect on equity markets, I think in the long term, the innovation in this market, you see that the top 25 companies in any index here, and you see the change that you see over time. So you have new companies that come up with new products, new services, and so the opportunity for investors is tremendous in the long term in the US market.
Great. So I'll move on to the next question. Why value investing can mean different things to different people, and what do you mean by it, and how Sameeksha PMS adhere to it?
For value, and then Ishwar can also, but for us, the value investing is being able to explain value using sound financial tools. So for example, if it's a company that has growth potential for another 30 years, we don't mind looking at that. But we want to be able to articulate it. We want, if it's a particular industry, which is at an early stage of evolution in India, but it has evolved much further in, say, China or other countries that have kind of gone through a similar path of economic development, then we would use that as a proxy and kind of adjust for the factors related to India, and then create an industry model for that particular business or that particular industry, and use that and link that to the financial model for the company and capture that entire growth horizon. And after doing that, if there is sufficient return, then we would invest. So that's what we mean by value. So it is not, value in a Graham and Dodd sense that, when they look at, stock available below replacement value and those kind of very deep value principles. So for us, value is not just limited to that, but value is what we can articulate through sound assumptions and, a solid financial model. So today, if you'd ask me, I see value in some large private banks because the growth horizon for some of them is pretty long. The whole COVID situation has actually strengthened them, and they could potentially still be very good for investments. So that's what we mean by value. I mean, Ishwar, if you want to add anything.
Yeah, I think one of the things, the two things that are very important in the process, right? I mean, the first is that the company is generating good return on its invested capital. And the second is we look at the cash flow generation of the company. And when we look at value, the most important thing is that value of future cash flow or whatever that growth period is significantly higher than what you're buying it for today. So just using traditional metrics as PE and price to book is a narrow way of looking at value. We look beyond that. We try to see, what is the growth potential of the company and what is the value of all the cash flow the company is going to generate. And that allows us to pick, we think, good quality companies and avoid value traps.
Thank you, Eswar, and thanks, Mr. Bhavin. So we'll move on to next question. What is your say if you are well invested currently? Should we hold on or liquidate some money? And what is Sameeksha's cash holding as of now?
It is a nervous situation, I must admit. In fact, when I look at the market, if we look at the earnings multiple in relation to the interest rate, for example, that is an important measure. We also look at implied growth in the market. Uh, and when you look at all that, we are no longer in that area where it looks like it is. I mean, it's clearly above, I would say, a long-term average. So, we have clearly gone into that territory. Even if I look at the small and mid cap, small cap is clearly, at a one standard deviation above average with respect to Nifty in terms of the valuation. So it is, and when you look at individual stocks in our portfolio, some stocks are approaching our target prices or are already approached target prices, and we are selling them as well. So I think that the cash levels have increased, closer to 5 to 6%, and perhaps might go up even more on that basis. Eswar, you want to add anything?
Yeah, I think as Bhavin said, we've been a bit nimble. We had higher cash going into the crisis. We deployed it when valuations were more attractive. We're getting a little more cautious now. I think there are certain risks that maybe the market is not appreciating. One is that COVID is still a problem, and there's always a fear that even as the economies come back on stream, that you can have a recurrence or increase in cases. So we've increased cash gradually, but we still see opportunities, and we'll continue to invest in those kinds of opportunities.
Great, thanks. The next question pertains to the slide which you are being candid in talking about your mistakes. Somebody is interested to know, in two instance you misjudged the governance. So can you share how you could have avoided those mistakes?
So, I mean, in fact, probably there is more than two, I would say. But, let me just talk about 2 or 3 examples. And I would probably won't may mention the names, but, I'll actually give the context. There is one company in the pipes industry, steel and related pipes, actually excellent business, well-established player, doing a lot of interesting things, a great story. However, they created a side pocket. And the explanations given for them were not convincing, and we decided to exit, knowing very well that the company actually is doing very well in the market, and there was a potential that stock could do well, and the stock has done actually very well. How could we have avoided this? I don't know. Maybe we probably could not have avoided, because there was no sign at the time that we invested that something like this could happen. This all happened after our investment. In another instance, the company we invested, we later found that there was a lot of market manipulation of share prices by the company itself. Business looked good, but that factor kind of alarmed us. And then there was a negative fundamental development with the business, linked to a government contract. A change of government resulted in a cancellation of the contract. So there is a kind of a significant risk, that we probably underestimated at the time of investing, regardless of the share price manipulation issue. So, I think, so again, maybe having one more check, trying to think harder about single customer risk of this nature, is also, I mean, government is ultimately as, like a customer, right? So that would probably another learning for us.
Right. So the next question, what does Sameeksha do when after investing it realizes that the company has taken a step not in the best interest of minority shareholders?
Yeah, so, I think, in fact, we are currently in one situation like that, where a company is has a MNC parent. And I know that some investors use this as a rule to not invest in companies with MNC parent. I mean, we have not deployed that rule per se, but here is what happens. So the company has an MNC parent. They also have another company in the same sector, and the listed company, the parent MNC parent owns 70%. The unlisted they own 100%, and this listed company is giving a loan to the unlisted company. The first thing we did is contacted the management and asked them why. They've given us a lot of reasons and a lot of comfort that this is why this is not such a bad thing. I mean, and this won't be like a repeated instance of this. There are potential opportunities to invest in the business for this company. And so for us, I think the way, I think Eswar put it very well, that this is like first yellow flag. If we get another yellow flag, then we should exit. So we are not kind of, it's not an outright, red flag situation for us, but it definitely kind of prevents us from investing more aggressively in the same company, even though the price may be still be right to invest.
Thanks, Bhavin. So the next question, perhaps most of the client, broadly wanted to understand this question. With an unexpected rally in the market, when Nifty price to earnings is at lifetime high, is this the right time to invest?
So I think, as Eswar already said, and I think I also alluded to it, I mean, I think it's time to be a little cautious. It is not like a situation where we don't find any investment ideas, or the stocks that we are owning are all like, at valuations from which we have to completely exit. But I think I mean, I think I haven't added any new name in last few weeks, and that I think tells me that we are probably not finding a lot of good ideas right now, new ideas, that is. And so I think it is time to be a little cautious for sure. I would not go aggressive in the market at this levels.
So having said that,
yeah. So you should.
I could add something. Yeah.
Please.
I mean, I think the thing that people should realize is that we are professional investors, and we would address those concerns in terms of if we think valuations are not great, we're more cautious in terms of how we position the portfolio. I think there's a risk that, and I've seen this with many friends, that they get afraid of valuations and they just sit the market out, right? So I have people who have not invested since the 2008, 2009 crisis, right? So you miss a lot of opportunities. So the advice would be, you can trust us to do right in terms of taking those caution, being cautious about things, and let us make those decisions.
Right. So with that note, let's say somebody wants to invest with Sameeksha Capital. How do you construct the portfolio at current level? Do you deploy the money instantly, or what is the time period you take? Just for an understanding perspective.
So I think there are two things here. For every stock that we invest, we will have a target position in mind. Whether we want to take a small, say 2 to 3% position, or a very large position. And generally, we don't take very large position immediately. I think we like to observe a few things, because sometimes and often we find that we learn a lot about the company even after we invest. And it will be very rare that we will go all in, in immediately when we invest. So we have, basically, depending on the liquidity, attractiveness of the business, our conviction, we would take anywhere from 3 to 15% position, and we would do that not in one go, but sort of over a period of time. And so today, if somebody came to invest, we would look at what's in our portfolio that is still worth investing, and there are some names. It's not like we're not seeing anything worth investing, and we will buy we'll try to bring those clients to our target level in those names. Now, it may happen that there's new clients. Some of those names may end up having a higher position than the older clients, because older client portfolios don't have as much cash. So that deviation will be there. But that is what we mean by customization. That we treat every money as a new money, as a sort of the unique portfolio. And so that's how we will, basically invest. And so how long does it take to deploy all the money? Well, it really depends on the market. I think it could take, a year maybe. Probably not longer than a year in general, because market tends to give, some opportunities during a year, generally speaking.
So in nutshell, the takeaway is that investor need not worry necessarily because of the valuation concern. Sameeksha Capital, will take care in terms of managing your money. So I'll move on to the next question. Usually, Nifty and Bank Nifty are highly correlated, but as of today, Nifty trading at close to 7% discount when comparing with their all-time high, whereas Bank Nifty is about 40% discount when comparing with all-time high. Looking at your portfolio, your BFSI allocation is close to 35%. So would like to understand broadly your view on this gap and your view on this sector.
So we are, in fact, during especially through the COVID and coming out, we have taken a conscious choice of investing in financials which we consider to be very safe and likely to benefit from any consolidation that will happen in the sector. So our positions are with top private banks and some non-banking companies which we consider extremely safe. We pay huge attention to lending practices and do not take risks in that area, even though some opportunities may look very attractive. And if we find after investing that lending practices are not consistent with our philosophy, then we have even taken an exit. So as you said, and the same thing comes up in our analysis, and I think I mentioned earlier in the comment also that we do find value in the top private banks, and that is, I think, reflected in that Nifty valuation gap today. And that gap is perhaps because of the concern that if the economic crisis continues, then obviously the financial sector gets hit the hardest. They are leveraged play on the economy after all.
Thanks, Bhavin. So I'll move on to next question. Mr. Udit Yadav was asking, do you believe in averaging down? P expansion or a valuation expansion is a key for driving returns. So how do you reconcile this with this business fundamentals? In India, high mode companies trade at high multiples for a sustained period of time.
If you go back to my presentation, we do believe that market tells us something. So if the stock is falling, then we actually first ask the question, have we missed anything? We want to, is it falling for a reason that we can live with? In other words, it's just some temporary factor or a reason not something not well understood in the market. Maybe stock is not widely owned yet in the institutional community. A number of factors can play a role. And after doing all that, if you feel that no, there is no genuine reason, then we will average down. And that's and as I said earlier, we don't build our entire position in one go, and so averaging down also helps us in that regard. So that was the first part of the question. I think I'm not sure if I caught the other part of the question.
It was correlation with that. You were saying that P expansion or a valuation expansion is a key for a driving return. How do you reconcile this with the business fundamentals? In India, high mode companies trade at a high multiple for a sustained period of time.
Okay. So, when we invest in general, we are, we look at 2 to 3 year horizon and we say, what is the price objective for a stock 2 to 3 years out based on our detailed financial model, as Eswar explained, based on free cash flow. And at our target price, what will be the implied price to earnings and price to book multiple? And would that make sense? So if the assumption suggests that there will be that it requires a significant PE multiple expansion, then we are a little cautious, because we don't want to invest believing that there will be a multiple expansion. If the multiple expansion happens, it is like a bonus. I think Muthoot Finance is a great example. When we invested, it was trading a single-digit multiple. Now it is in low to mid-teens multiple, because it's a story has been well understood by the market. It's now much widely understood. So, I think, but that has happened as a bonus to us. It is not something we invested going in believing that it will go to a 15 times multiple. And I think the question is very valid that, in India, some companies do trade at very high multiple for a sustained period of time. You would find that many of those companies don't cut don't make the cut for us, because the implied rate of return, in spite of factoring in 25, 30 years of growth, is not sufficient. And, we can get into a debate on that with any investor, in a separate, at a separate time. But that's the reality of India, and those stocks don't go in our portfolio.
So fine, Bhavin. So the next question is quite interesting. So how do you differentiate from other PMSs? As a retail investors, it is hard to make a decision as every PMS company claims their strategy to be the best. How unique is Sameeksha Capital?
You know, Actually, our strategy may not be the best. I've tried to articulate how we do things and what has been the result so far. We don't have all the capabilities. There is for example, I'll be candid to admit that in last several months, there has been some phenomenal returns generated in chemical and pharmaceutical sector. We have participated in some, but I don't think we have done as well. We have taken advantage of that as much as we could have, had we kind of been well prepared in terms of our work to invest, because I think the theme was obvious to me, or obvious to us, but we were just not, and we don't just buy based on kind of a general level work. We have to do all our work before we invest. So we are far from perfect. We have made lots of mistakes, but we try to learn from those. And I think the most important thing I can say is that we have a process. We are wedded to that process. The investment decision is not made based on my kind of intuition or some gut feel or whim, or Eswar's gut feel or intuition. It is based on the work that is done by the analyst. If the analyst work comes to us suggesting don't buy, then we'll have to have very strong reasons to kind of buy that, and then essentially going back and forth with our research team, and then finally coming to a conclusion. So it's a consensus driven approach in that regard, and there is a process to it, which I think is most important thing I can say in response to that question.
Thanks, Bhavin.
Let me add just
Ishwar.
one thing. I think, we both trained, have MBAs in the University of Chicago Booth School. And I think one of the things is we believe in rigor. So all the analysis is very rigorous, and we're very disciplined in terms of how we approach it. So that's what I think investors get, is a very consistent, discipline, and very rigorous process in terms of how we're approaching, picking stocks. So every single stock that goes in the portfolio has to meet all of these criteria. In the process, we may miss something because we didn't move it fast enough. It took us longer to kind of get grips on things. But at the end of the day, I think people should be comfortable that we're very disciplined and very rigorous in our approach.
Thank you, Mr. Eswar. So we have done with questions. Mr. Bhavin and Mr. Eswar, is there any closing note would like to highlight to the participants?
I think I do see some questions in the chat. Happy to, if somebody can send us their question, we'll be happy to answer them offline, and kind of in a more thoughtful way. But I most importantly, I appreciate the time that participants have given us to listen to our story, and welcome to. We'll be looking forward to another interaction like this in future.
Great, Bhavin. Eswar?
Yes. So thank you for the opportunity to present what we do, and we look forward to working with anybody who's interested in what we do.
Great. So as a practice, we collect the questions whichever has been missed to address or unanswered. So we will be taking these questions to Sameeksha Capital, and we'll be reverting as we've been doing earlier. So Mr. Bhavin and Mr. Eswar, thanks for your time. It's wonderful connecting you, and participant, thank you so much, and looking forward in hosting you in another insightful event. Thank you.